Please join me in welcoming our first panel today on the state of the market and managing and how the UK and the US markets are managing the regulatory uncertainty. Over the next 50 minutes, we will look at the current trends, challenges and opportunities that are shaping the industry, both in the UK and in the US. I'm joined by a terrific panel who brings a range of perspective on the litigation funding place, and I'd like the panelists to please introduce themselves. Sarah?
I'll start. Hi, I'm Sarah Johnson. I feel like I should go last because I'm actually here from the United States. I'm the head of the litigation investing strategy at the D.E. Shaw Group, which is a large investment and technology firm. We started our strategy about 8 years ago, have been primarily focused in the U.S., but recently expanding into the U.K. Thank you for having us.
Hi, everybody. My name is Rob Rothkopf. I'm the founder and managing partner of Balance Legal Capital. We're a specialist litigation funder based here in London with a Sydney office as well. We just turned 10 years old, and we focus on investing in the UK, Australia, other common law jurisdictions.
Good morning. I'm Robert Marven. I'm a barrister at 4 News Square. I'm one of our strong costs team, and I spend virtually all my time doing costs, litigation, funding, competition, appeal tribunal, etc., etc.
Hello, I'm Nicholas Marler. I'm head of technical underwriting at Litica. We are an adverse costs and contingent risk insurer with offices in the UK, Australia, America, and continental Europe.
Thank you, Nick. I'm Susan Dunn. I'm founder of Harbour Litigation Funding, which is a large private funder which funds all types of claims and law firms, like Rob, primarily in common law jurisdictions around the world, so all types of claims that you can imagine. And I've been funding for 23 years, which is several lifetimes.
Thank you. So as a first topic, I wanted to look at where we are in the market today and how the regulation impacts the funding industry. So maybe Susan, if you can comment on the UK market, and Sarah on the US market as well.
Yeah, so I was chatting with somebody just before, and when you've been doing this for 23 years, there have been so many different challenges over the years. I remember when Fund 3 maybe we were trying to raise, and the investors were impacted about the fallout between Germany and Greece. And you talk about that now, and people go, what was that? I don't remember that. So over the years, there's always a something. And you don't know what it is, but there's always challenges, problems. I do sometimes say that the life of a litigation funder is one mostly of disappointment for a host of reasons. But I think that more recently, it's been very much that regulatory side. So there have been macroeconomic issues around fundraising in a higher interest rate environment. But what we have seen here, because of a variety of things, has been on that regulatory front. So most of you will be familiar with the impact of PACAR, which has the risk of making funding agreements unenforceable, and with particular focus on the CAT. And we can see when we look at the statistics for claims filed in the CAT since that decision have seen a significant drop in those, because A, those cases are very expensive, and B, with the uncertainty around the enforceability of the agreement, sensible people would say, I need to just pause and see what's going on there. We also funded the BT case, which everybody said, yes, you're definitely going to win, and that lost, so that also then gives uncertainty around, well, what's the standards in that forum? Separately, we had the Civil Justice Council report, and that was helpful in terms of saying PACAR really must be overturned. And so that was helpful. But then we have all the changes in government, which means that the people you were talking to about getting that done move. So, what I have learned about getting legislation done in this country is I'm amazed any legislation gets done in this country. So I'm impressed by anybody who does so. The Civil Justice Council report I thought was brilliant in terms of its ambition about how things could be done and should be done. And it didn't do some of the things that people feared, which is things like caps on funders' returns, which I think is the right decision. And I think that whole engagement was one where there was a proper listening, evidence-based approach to the recommendations. Now, when and how those recommendations get implemented in a world where we don't have any money for doing these things is interesting. And then recently we've now got this review, prematurely in my view, but there we go, of the CAT regime. I don't think we have enough information about outcomes in the CAT yet to be doing a review, but somebody somewhere decided that we should do a review. And therefore there is something which has been issued, which we are all looking at. And can I urge you, to the extent you're inclined, even if you only answer some of the questions, the submissions are due on the 14th, which is next Tuesday, to take a look at that. And if you have anything that you want to emphasize in response to that, it is in all of our interests that the maximum amount of information is submitted about those cases. So, combination of these things, combination of challenges around fundraising is, I think it's a difficult time, but I think it's always been a difficult time in what we do.
So maybe before we switch to the US, Rob and Robert, I wanted to follow up on this and see, are you seeing a similar impact from, the PACA, the CJC review, SRA review that's been done in recent year?
Yeah, I would say that demand for funding is still very high, but there is hesitation whilst we have to acknowledge that defendants are still able to go into court and challenge the enforceability of litigation funding agreements. And instead of being laughed out of court, these arguments are entertained and court time is taken up, and it's a question that the Supreme Court will be deciding whether to give an appeal permission on. So yeah, it's a bit like the banks one day finding that a Supreme Court decision has decided that their mortgages might not be enforceable. You would naturally see a slowdown in appetite to lend. And so it's definitely an own goal for this UK government not to have just fixed it. We got very, very close under the last government where it had bipartisan support. Labour in opposition was very supportive, and then things have slowed down. But the positive point is that there is actually a lot of potential in this market. We're achingly close to tweaking some of the conditions that could really lead to, I think, to a boost in access to justice and activity in this market. You had the CJC unambiguously say fix PACAR and make that a standalone bill. It's already been drafted. There were a couple of other recommendations in there that I thought were also very important and quite exciting for this jurisdiction. They said, look at expanding the opt-out regime to non-competition class actions. As everybody knows, competition is currently the only place where you can do an opt-out class action. And so we still see lots of cases, really, examples of corporate wrongdoing having harmed a lot of people, but only in small amounts. And you can't get that book build viability going because of behavioral economics. People don't, there's too much individual inertia to make people sign up, so you don't get the book that you need to hold corporate wrongdoing. And then there was the other point, I think, in the CJC, which was excellent, was this idea that in certain circumstances where defendant conduct of the litigation has been particularly egregious, there's, I was a litigator at Herbert Smith in a prior life. The defendant side law firms know the game that they need to play for their clients, and that is delay, fight every point. And the antics that we saw in the post office case are not a far cry from things I think that we sense are happening in other cases. If the courts had the jurisdiction, let's hear Rob's point on this, the jurisdiction to make the defendants pay the funding costs instead of it coming out of the claimant side, that moral hazard would, I think, be enough to put a stop to a lot of the unfortunate litigation culture that has crept into our jurisdiction, and would, again, be a huge boost to opening up the kinds of claims that become viable.
Thank you very much. I'm going to leave that last point till last, just so I have time to think of an answer. But on the deterrence effect of PACAR, I mean, yes, it is undoubtedly having a deterrence effect. And I think, as Rob said, the broader point is just that it has given a license to having a crack at funding agreements in a way that previously was regarded as an entirely fruitless exercise. Actually, although there are problems with PACAR, it's now pretty clear after a subsequent Court of Appeal decision what you have to do to have a funding agreement that is not going to be unenforceable for that reason. There's things you clearly can't do, but it's clear now, I think, pretty much what you can do. And funders on the whole were pretty quick to redraft agreements or amend existing agreements to fulfill that. So it's not, I think, that funders are worried that they're going to get clobbered as an unenforceable DBA. It's more the general point that it just is open season on things that were previously, not considered worthwhile. That argument had failed twice in a very strong CAT and the Court of Appeal, and yet it was overturned, and the funders lost in the Supreme Court. I think there's a broader point as well. It's not just PACAR. I think other things are also happening, particularly in the CAT, that it is being found that things are taking longer than people expected. On the few cases that reach the end, actually the settlements or outcomes are a lot less than people were hoping for. And I think that is also having a deterrent effect. One thing that could be done to open it up is that outside the CAT you could have opt-out class actions. We only have it in the CAT at the moment. And therefore there are sometimes really quite artificial attempts to present something as a competition appeal case, where really, if it wasn't for the fact that you could only have opt-out in the CAT, that the claim would more naturally fit elsewhere. As to whether the cost of funding should be recoverable, that is one of the things that's on the table on the MOJ discussion, and the Department of Business and Trade's counter discussion, which I'm going to say a bit more about later, would no doubt push, those who are responding to that, many of them would no doubt push against that. My own view, for what it's worth, is yes, it would be quite a good thing, but I don't think it's going to happen in this jurisdiction any time in the near future. Others may know better than me, but we've only just come out, relatively recently, a decade ago, we scrapped a system where additional liabilities could be recovered from the losing party. And I suspect there will be quite a lot of resistance, desirable though it might be, to putting that back in again. But we will see.
Thank you. So Sarah, how does US perceive the UK market now? And I guess also if you can comment on the regulatory developments in the US as well.
Sure. I'll start with the UK market. And would say all of what everyone's saying resonates with us. I think part of the reason we found the UK to be an attractive opportunity set to expand into is the strong legal system, and in fact, I think a relatively supportive history of litigation finance. I think uncertainty is not a good thing. So it's not a good thing because you're not sure, obviously, how contracts will be upheld, what sort of the rules of engagement are on all of it, but also, as was pointed out, the duration aspect is it's just going to take longer to resolve all of these things, which puts pressure on investments. So I think the sooner all of that is cleared up, the better, just when you're looking at the market. In the US, we've also had regulatory headwinds. They're different, listening to what...
I think the mic doesn't work. Maybe Rob could...
Is this better? No?
No.
Not at all. Okay, thank you. Or maybe we'll just put that. Is this better? Yes, okay, thank you.
It's good we missed all the uncertainty in the UK market.
Exactly.
Let's talk about US.
We'll move on from the UK uncertainty and move on to US uncertainty. In the US, it's interesting. We've had our own challenges on the regulatory front, but they looked a little bit different. Earlier this year, there was a proposal introduced into a tax bill, actually, that would have significantly raised taxes on investment returns related to litigation. So it wasn't just the litigation finance industry, but it was targeted at any investors in litigation. And, it was ultimately pulled out of the bill and defeated. But if it had gone through, I think there would have been a material contraction in the litigation finance industry. And we think this is probably not the end of it. We think it'll probably resurface either at the federal or state level in the US. I would say, in terms of trying to think of a silver lining, it has brought the industry together in a way that we really weren't well organized before. And there's been a lot more emphasis on educating both, I would say, sort of our, the legislators, but as well as the broader public as to the merits of litigation finance and how they help strengthen our legal system and improve access to justice. So there's been much more attention and time paid to that in the US lately.
And Nick, do you think this uncertainty in the market affects pricing for insurance?
I think that the candid answer is I think a lot of insurance products, when you consider the risk that they are taking, are probably underpriced. And I think there's been a bit of a hardening on pricing, whether it's adverse or capital that's being insured. And I appreciate our industries sort of work in different ways. But when you consider the relative cost of capital, I'm not sure they're reflected in the different pricing, in the different returns that are obtained by funders and insurers. So I would expect a hardening of pricing to be maintained by insurers, but obviously that's my self-interested view, and time will tell whether that's borne out.
Thank you. As next topic, I wanted to discuss the maturity of the UK market, products, structures that we're seeing available, and market participants. So Rob, Susan, do you think the UK market reached its maturity, or there is still some potential for growth? And how does it compare to Europe? And what is the actual demand for funding that you are seeing both in UK or European market?
Shall I go? Can you hear me on this one? Good, right. Yeah, I'll go first. I mean, I'm going to speak about the UK because I know relatively little about the US. I mean, it seems to me that this is still a developing market. This is not a settled market. This is a market where the demands are changing and, broadly speaking, growing. And I think that investors' attitude for the market are not stable either. Everyone is learning from experience. As I said, I think there has been a deterrence effect, not just because of PACCAR, but because some funders are seeing that the returns are lower and very importantly, much more delayed than they had thought when they invested. And I think it's also important to understand, I mean, different funders fund differently, but a lot of the time there are funders behind the funders. Their arrangement, the sub-funders, if you like, their arrangements with the funders are not the same as the funder's arrangement with the class rep or the claimant or the group or whoever it is. Sometimes they are on arrangements where they expect to get a return within a fixed period, etc., etc. And that puts if the funder has taken a risk on where they're going to get a return, and some of them handle this better than others, but that puts pressure. And I think we are going to see issues emerging because some people who want to see funding as just a form of lending and credit, but it's not. You might not get anything back. You don't know when you're going to get it back, etc. And I think that those are issues that are still being worked through. So I very much see it as a developing market.
I'll chime in on that. I really do agree that there has to be a match between the capital structure on the one hand and the underlying assets. We've just launched a new fund, and it's just the vanilla LP structure. We have patient LPs, and we're very grateful for them. they understand that the cash flows from the cases can be lumpy, and duration is turning out to be longer than we had all expected. And on recent sort of fundraising trips, I found that the seat that I was in was always warm from this other outfit who had been pushing a structure that I just frankly didn't really understand, where they were offering investors a percentage yield on their commitment. So they could put their commitment in and they would see this interest rate nicely ticking up over time. And they even had a right to redeem their commitment within a year. I think they had to give a year's notice, and then they could have their money back. And my question was, well, from what liquidity? The cases underlying are not going to be generating that yield. So that's a totally artificial IOU. And it seems to be that there's this financial engineering or other dressing up going on in order to appeal to the trends in private credit and so on, which don't match the actual asset underlying. And I think that's that could cause problems.
Yeah, and I think that's highlighting a really interesting point. Is the market mature? No, because demand only keeps increasing for what we do, because there are still a lot of lawyers and their clients who don't know about litigation funding in its various guises and how it can be. So the graph has only ever gone upwards for demand. And of course, what happens over time is you see different things also developing. So, for example, we see private equity moving into acquisition of law firms or law firm shares. And you see credit funds and other funds coming in saying, we want to lend money on an interest-bearing basis. And so you've got new entrants coming in to take part in this. Where I have great concern, because those who are long in the tooth, like me and Rob and others, know whenever we look at something, we've reviewed thousands of cases, and so we have this very quick ability to look at something and go, oh, yeah, no, that's not going to work. And I am seeing a lot of people who are getting attention from funds who don't have so much experience to invest in things which people like us would go, hell no. And I do worry about that there is not so much experience, which means that things that really shouldn't get off the ground are getting off the ground, because if and when they go wrong, that reflects badly on us. And we are trying to make sure that people always have a positive experience of funding, but we've seen some of the things that have gone horribly wrong, and that isn't good for any of us. We never celebrate other people's failings. We want everybody to succeed, but we also want those who are doing this to really understand what they're investing in, because there is a lot of, well, I struggle to be polite about some of the things that are floated around the market. And you think, is this just a numbers game that you'll eventually find somebody who doesn't know what questions to ask and will therefore invest in something which we can tell you is never going to succeed? So I guess that's one of my concerns about where we are in the stages of things.
And just maybe to follow up on this point, so we obviously have a next panel on the private credit. So do we think, and there is a lot of interest that we are seeing from private credit into the litigation funding space, so do we think that the entry of private equity funds and hedge funds are going to change the litigation funding space, or has already changed the dynamics and pricing, or how it's going to?
I can start on this, perhaps as the sort of large hedge fund in the panel. You all can tell me how we've changed things, if at all. I guess I would say, like, in terms of the private credit question, so I've been at D. Shaw for 20 years. I sat on our public distress trading desk before we launched the litigation investing group. So we're technically under the private credit umbrella, but I think that's more a function of the illiquidity of this strategy as opposed to it being so credit-like. We have an understanding that litigation finance does not really function like a corporate loan, for instance. There's limitations on remedies. It's hard to foreclose. You can't necessarily do asset sales. Like when I think back to the restructurings and workouts that I used to do in sort of the previous career, we had a variety of remedies that, you know, once you've had a default triggered, you can move forward with them. That just doesn't happen in litigation finance. There's also more limitations on control. Although I think we are beginning to be more innovative about having private equity-owned law firms, it's not straightforward. It's not like just taking over shares in a public company or even a private one. Not to mention you can't control settlement. It's just, that's not a place that we would go in our agreements. And so we focus more on alignment and I think like very carefully structured documents. But that's very different than most of the rest of corporate credit. I also think Rob touched on sort of like the cash flow piece of this. A lot of private credit funds are very focused on showing interim cash flows. They have final maturity dates that they need to meet. I think timing and duration has been and continues to be one of the challenges for our industry, and it just does not line up well for those fund structures. I think we're going to talk about different ways you can try to solve for that, but those are some of the pieces of litigation funding that make it less natural for private credit.
Yeah, and I think in my experience, I'm seeing a lot more, seeing serious amounts of capital being deployed by credit funds, by hedge funds. So, you know, 9-figure deployments on a basket of cases is becoming increasingly common. And I think sort of 5 years ago, those sorts of sums would be an entire fund. So I see a serious inflow of capital, and I can't really see that that's likely to reverse anytime soon.
Thank you. And maybe to pick up on Rob's earlier point on how when we do fundraising, there are different structures that are being offered to investors in the litigation funding space. So one of them is CPI insurance, which we are seeing more and more being used or requested both when fundraising into a fund, but also for funders trying to protect their investment. So Nick, is this something, maybe you can comment on how it's being used, whether, you know, what are the criteria, has it been paid out or not paid out on certain actions?
Yeah, of course. I think in recent years we've seen you know, an explosion in the demand for capital protection insurance. So only a few years ago we might do 1 or 2 CPI policies a year, but now we're doing 5 or 6. And you know, given that each one of those could be a high 8 or even 9-figure transaction, that is really quite significant growth. For those that are sort of unfamiliar with it as a product, it is a specialist insurance product, and the intention is to hedge your downside risk. So if you're underwater upon the maturity of the policy, then the insurance is intended to make you whole, but not to put you into profit. So as the name suggests, it's there to protect your capital, not to protect your profit. And it is incredibly versatile, so you can insure any number of cases in a portfolio. You can insure a primary transaction, you can insure a secondary transaction, you can insure at the law firm level, at the fund level, at the individual LP level. And what we're seeing is that even if it's not individual LPs that are the insured entity, then it's often LPs that drive demand for CPI. And the primary benefit is that it enables the fund manager to obtain a materially lower cost of debt. And so in that regard, CPI is helping to bring in new source of capital into the market. And as I said, I expect that trend fully to continue for some time. In terms of what we look for, CPI is naturally suited to large, well-diversified portfolios of cases. So the limits we can provide, they are a function of the size of the biggest investment in the portfolio. So for example, 25 million investments will be far more attractive than 20 million investments, even though the aggregate sum is the same. So it's a little bit like stock picking. From a downside perspective, you're not going to bet the farm on 2 or 3 stocks, but you might bet it on an entire index. It can take a great many forms, so we don't necessarily need diversification by geography, so you could have a 100% UK focused portfolio, and we don't even need diversification by tribunal. So I've got one on at the moment that's composed entirely of cat cases, but you do need a spread of cases that are fundamentally unrelated to each other and that therefore don't aggregate against each other. From a timetable perspective, I need a sensible horizon on the policy, so anything from 5 to 8 years before maturity. And it probably should go without saying that I need a demonstrable track record from my counterparty, so they need to have had a proven track record of investing in litigation finance and evidence of a robust due diligence process. If it is a forward-looking transaction where the cases essentially don't presently exist, then I will usually require a veto right onto what goes into the portfolio. I think the big point to remember with this is that it is there to protect capital being invested into a transaction that you would otherwise be happy to proceed with without the benefit of insurance. The intention is not that it's a free hit on something that's really exotic that you would otherwise go nowhere near. So we do have to maintain, we have to keep our guard up from a sort of adverse selection risk point of view. But yeah, the possibilities, because it's inherently bespoke, the possibilities are more or less endless with CPI. And as I say, I expect demand to be sustained well into the future for this.
And have you actually seen it tested in the market and paid out, or maybe not paid out for certain reasons?
Litica always pays its debts, but we've not had a single unsuccessful CPI transaction, or I should say the insurance we have placed on all of our portfolios has not been called upon. Obviously, some of those portfolios are still up in the air because you only have a single crystallizing event at the end of the policy. But certainly, speaking on Litica's behalf, credit risk and credit quality ought not be an issue. We have, we have extremely well-rated carriers, but no, to answer the question, we've not had any coverage disputes. But obviously, if you are calling upon CPI, then something's obviously gone quite seriously wrong based on what I said about how well diversified the underlying portfolio should be in the first place.
Thank you.
If I may, we've seen capital protection insurance only in respect of one particular LP who is arranging it themselves, and I get the impression that it's so that they can, from a regulatory perspective, broaden the base of their investors, so they can raise capital from the more retail side of things, and then offer a lower risk product by getting this capital protection insurance. No other LP that we've ever had has ever asked for it, as particularly not at the fund level. And it's interesting, Nick. It's obviously good to hear that it's going well on the insurance side, because not many claims have been made against the policies. But I think that goes to some of the feeling that we have and that our LPs have, is that it's a very expensive policy, and something that you actually shouldn't need if you've got a fund that is diversifying across the metrics that you outlined in your DD requirements. And so it's also very expensive. So this LP that we were talking to, still coming in, their commitment level was going to be huge. Now that it's net of the upfront premium that's going to the insurers, it's less exciting. And that is a big chunk of money that they've got to make back before they get profit. And most of our LPs actually, they want the returns, and they don't want that depression on returns by spending too much on insurance.
I suppose I feel obliged to respond to that. So we obviously offer very good value for our products, but the analogy I often use is that the Titanic was unsinkable, it was insured against sinking, and it sank. So, and Lloyd's of London paid out in full 30 days later. So I appreciate the point Rob's making, but we obviously have differing views on it.
Well, to move on to our final point, maybe if panelists can comment on the fund structures, on the funding side, on the fund structures we're seeing in the market, and types of cases as well. Is it more law firm financings, portfolios, group actions, opt-in, opt-out? So I think this point we haven't covered yet. Who wants to start? Susan?
Yes, so what we've seen, particularly with our fifth fund, what is that where you used to just have like fund, GPLP structure. In this last fund, we've had quite a lot of investors who are in there who've said, well, we'd actually like to do other things too that are not, either don't fit within the portfolio parameters or whatever. So we have found a lot more side vehicles with people saying, oh, can we do these types of cases, or can we do law firm credit? And that's absolutely fine because we're good at managing all of those things. So definitely a lot more individual bespoke vehicles, which of course brings with it extra admin, but is another means of securing additional funds. So it's that's the advantage of being amenable to doing such things. In terms of cases, again, if you look over the years, I started life just in the insolvency world because that was the only world that understood funding and like, we've got no money, we need the money. And of course, over the years, now everybody uses funding. So the types of cases are completely across the complete gamut of cases. And so we've always been quite omnivorous, and I think quite a lot of people are. Some people focus specifically on different things. One thing I will say is that during COVID, we sort of had a re-examination because we're obsessed by our own data, as you might imagine. And we did a re-examination of some of the forays that we had taken into jurisdictions which, with the benefit of hindsight, we didn't have sufficient experience in. So we stopped funding in some of those cases. And then in other cases, you just found, well, you had like top-tier law firms, peer-reviewed by top-tier law firms, doing particular types of cases. So in our case, bilateral investment treaty cases, just an utter disaster. It didn't matter what we did, with whom, we never won. And then you'd say at the end to the two firms who were involved, why did we lose? And they go, do you know, I just don't know. And, if the answer is, I don't know, you don't know how to avoid it in the future, right? So inevitably over time, you figure out what you're better at, what jurisdictions you're better at, and that determines where you want to go. And the duration point has become one of the most tedious aspects because things have just got slower and slower and slower over the years. So, trying to look for things which aren't so slow. And unfortunately, lawyers, in the same way that they're overly optimistic about budgets and claim values, are overly optimistic about durations, and that's frustrating. But certainly, this jurisdiction remains our favourite.
I could just speak to a bit of the fund structure. We're probably unique in that we sit as one strategy in a large multi-strategy fund. So I would say that I think the best solution for litigation funding is evergreen capital, but I think that's probably the least common fund structure that we see. We use our sort of like primary, what we call like the hedge fund, which does not have like a defined maturity or end date. So that gives us a lot of flexibility. However, we also have more typical private credit investment vehicles. And I think we're seeing more and more of those come into our market, as we discussed, as they're looking for sort of new opportunities, less correlated, higher returns. Also seeing interest from investors in putting together bespoke funds so that some investors want more or less exposure to litigation finance. They may want the, let's say, fully insured, less risky end of it, or they want no insurance and the more volatile equity-like returns. So you see just a variety of different appetites even within our market. In terms of the cases we're seeing in the UK, we see predominantly single case investments, mostly law firms looking to get budgets funded. And that's, for us at least, different than the US, where we see more monetizations of plaintiff claims who are looking for operating capital or, sort of maybe more for costs of the case. We do see some portfolios, but not as often in the UK.
And would you say, because the law firm trend was very big last year, would you think it's still staying on and developing, or it's more sort of shifting to smaller portfolios or single cases? Anyone, Rob?
We have generally, our strategy is to focus on building single case portfolios as well. We have just decided that the risk is it's a different set of risks when you're lending to a law firm. You're taking on operational risks, and they're complex businesses. There's obviously been some high-profile distress in that style of lending of late. So it's not, and I think a couple of years ago, we would be approached by law firms who said, we want to get a facility in place across all of our cases. We'd say, where are the cases? He said, well, hold on a second, we'll get the cases when we have the facility. And then you find that we were a bit concerned that you then are outsourcing your case selection. And it's something that we wanted to keep in-house. So in terms of demand right now, I can't comment.
Just on that, I mean, I have seen, I think over the last few years, an increased amount of portfolio funding where the funding is to the firm for a range of cases, and often the funder's remuneration isn't actually a direct cut of the claim of the damages, it's a cut of what the solicitor's getting back when they're on DVAs, which have always been slightly tricky territory in this jurisdiction. But I think, just echoing that, I'm yet to be persuaded that that's working awfully well for those involved. It does happen, but it does seem to me that it isn't generally speaking, working at an optimum level for any of the players, but we will see.
That's really interesting, and I guess we'll discuss at a later panel on law firm funding, and at the end on the trouble panel, more on law firm funding. But thank you. Looks like there is a bit of a shift from large portfolio or law firm funding as counterparties to smaller portfolios or single cases. Just to wrap up, can I ask each panelist to just comment briefly on one most pressing risk that the industry is facing, whether it's duration or regulatory uncertainty, adverse costs, or others, and also what do you see as a trend in 2026? Let's start with Susan and just go back to me.
I didn't know which end we might be starting. Yes, I mean, like I said at the beginning, there's always something. And there's always sort of Donald Rumsfeld known unknowns. So there's bound to be something else that will come along that will be challenging. But I think for me, one of my bugbears, I suppose, is the role of the lawyer. And that I want lawyers to get better at the use of technology, better at budgeting, better at not overstating claim values or durations. And so I would just like to see much greater discipline. One of the questions I think was asked of me recently was, has the quality of submissions improved in your 23 years? Sadly, it hasn't. And I think that's really disappointing because, people who just say, here's a link to my data room. Well, I'm not going to wander around in a data room. You need to tell me why you think this is a good idea and why you're backing it. So I think much greater responsibility, because the biggest beneficiaries, frankly, of funding are the lawyers running the cases. So I need to see them step up more and do a better job at how they submit, how they manage their budgets, and how they manage the cases, and not just see us as a walking wallet who is endlessly there for all the budget increases.
Thank you.
Thank you. In terms of predictions, I think for me, I see the continuation of a wave of institutional capital entering the space. All indications I see sort of point in that direction. In terms of sort of threats, I think it's quite a specific one, but I think there needs to be some realism in the cap on returns. I'm sure it'll be discussed extensively later on, but I was astonished by the outcome in Merrick's, where if you take a really big step back over a decade of litigation, the return to the funder after the return of its investment, it would have been better just sticking it in a tracker fund, which is more or less risk-free. And if you consider the risk that we're taking, the duration, the fact that a very low ceiling but no floor was imposed and a large donation was made to charity, fine, all well-intentioned, I'm sure, but there needs to be some realism on returns, or else there isn't going to be any money to fund these cases, and thus the end of the tribunal will be upon us. is my crystal ball.
One thing I think to watch out for in the next 12 months is the interplay between the MOJ, who's got the CJC report, and the Department for Business and Trade that, as you've heard mentioned, have put out a call for evidence on funding and opt-out regimes in the CAT, which is not an entirely, from a funder's perspective, friendly and benign exercise. That is very much loaded on funding is a burden on businesses, which seems to boil down to saying that, you know, if a business commits a mass tort and has to pay out mass compensation, that's going to cost money. Well, who knew? But there are questions, and I echo the comment that Susan made earlier. Please do get in and reply to this, because there are questions like, do you think funders' rewards are fair and proportionate? And then, just in case you thought that was a neutral question, the next question is, how do you think we can improve this? So do have your say if you want to push back against a certain amount of leading questioning. But I think it will be interesting to see how the MOJ, that may not be perfect but broadly understands funding, and the Department of Business and Trade, that is being lobbied by people who are hostile to having funded claims brought against them, I think it will be interesting to see how that plays out. And that is the thing I would watch out for in the next 12 months.
That's well said, Rob. I think, you know, the converse side of the coin is that this is a really important opportunity. If we can convince the MOJ and the DBT of the fact, you know, that we all understand in this room, rule of law is essential, and we are a really vital part of the fuel that keeps the ecosystem going. They also should not be beguiled by the hostile elements that are lobbying on this, you know, anti-business angle. When you know, there've been recent surveys, Bain & Co. Transatlantic Survey, where the U.S. investors identified the UK as a very important destination for inward investment, mirrored by a PwC survey earlier in the year where global CEOs identified that the UK as the second most desirable location. And I saw Sir Charles Bowman, the former London City Mayor, speaking about that survey and his conversations with CEOs who had said to him that the three conditions in the UK that make the UK such a desirable place to invest were the top three: rule of law, and rule of law. And so there is actually a lot of consensus in the business community, in the international community, about how important the courts are and how important litigation funding is. So don't let others tell you otherwise. And just while I've got the mic, the innovations that we need to see are, you know, the judges need to be more muscular in punishing misconduct by defendants when they're playing games around disclosure and duration. That would be a big help. And there needs to be that point about the moral hazard where funding costs should be on the shoulders of the defendants who've wronged the claimants, not the other way around. And an expansion of the opt-out would be very exciting indeed.
Rob said that so well that I don't I don't know how to add to it, but I will say, I mean, it's obviously true that that is one of the most attractive features of investing in the UK. It's one of the reasons that it's the second market that we've moved into, is because of the rule of law and also the role of litigation finance in it. It seems to be an asset of the UK, and it should start to be viewed as such. I think a couple lessons we had from the Tillis tax bill in the US was, you know, first of all, the impact would have been for funding to go away. And so there is a line that if you cross, the funding and the capital just starts to go away. And I think everyone needs to keep that in mind as a potential repercussion. But also, again, on the positive note, it brought people together in terms of trying to bring transparency to what we're doing and the positive impact that we have on the market. So I agree. I think it's a time for everyone to pull together and make submissions and you know, remind everyone of what a strength this is.
Thank you. And thank you for picking up on the important point on judicial scrutiny of funders' return. We'll cover it more in our last panel called The Trouble. Well, thank you for, please join me in thanking the panel for their contribution. And sorry, I don't know if there are any questions. I think just had 30 seconds for any questions from the audience. Can't see, yeah, a couple.
I think the question was whether there's basically, I'm not sure if it was of a specific investment or more like a fund portfolio, but it was about refinancings of deals. I think we've certainly seen, we have done refinancings of existing deals. Maybe this is more in the US than in the UK. We have done refinancings of deals, and we've been refinanced out. And so I think, you know, the question is just abiding by the terms of the contract. We always have the ability to be taken out. It's just at whatever the return level is at that point in time. Hopefully that was responsive.
Thank you. Any other questions? Can't see one. Okay, well, thank you very much. Thank you.